The Nikkei closing in at an all-time high on Tuesday, surpassing its last record set in December 1989. And while the index there is up nearly 45% in the last year, our next guest thinks investors should approach Japan with some caution from here. David Herro, portfolio manager at Harris Associates, also manages the firm's Japan strategy. David, it's great to have you. Can you talk a bit about what's different today than it was in 1989?
Well, there are some major differences. In 1989, it was really, by the way, this was the last trading day of the year. And Japan was experiencing what we call a bubble economy and bubble markets. Price earnings ratio 70 times, price to book ratio of the Nikkei 5 times. It was just a very expensive, liquidity driven market. But there were one other similarity to today, of course, was the exchange rate. Today, the yen's at 150 to the dollar. 1989, it was about 145. Those things were all very similar. One other similarity: the return on equity of an average Japanese stock in 1989 was around 7 or 8%. Today, just around 8.5%. But the big difference is the valuations are lower. The Nikkei's at 20 times versus 70. It's at a little over 2 times book versus what was 5 times book. But that stubborn return on equity, the profitability of a Japanese company remains the same. The rest of the world is at 15 to 20% return on equity. Japan's still just 7 or 8. So the market has been devalued. It took all this time since 1989 to reach where it was trading, but we still haven't seen a change in profitability. And this is the issue still with Japanese equities.
David, I'm glad you brought up the dollar yen. So 150 here went from 151 down to 140, back to 150 over the course of the last couple of months. If you're long Japanese equities, you want to remain long. What are you rooting for the currency? Continued weakness, or is there some point of diminishing marginal returns there?
Yes, it's a good question because there are 2 Japanese markets. There's the export sector, the foreign-facing, the foreign currency earners that love a weak yen. Recall, in 2011, spring of 2011, around the time of the earthquake tsunami, the yen was at around 75, 76. So it's a massive devaluation. And in the last 2 or 3 years, we went from around 100 to 150. Big devaluation. And this is one of the things that has propelled, especially the Japanese export sector. Now, if the Japanese monetary authorities decide to formally abandon their weak money and more monetary normalization, what you would see is a flip in the participation from the exporters to the domestic-oriented businesses, which will benefit from a stronger yen. So if they switch a monetary policy to more monetary normalization, which we've seen in the West, you would probably see a very positive impact on the domestic stocks, which have suffered during this yen devaluation, and you'd see a more negative impact on the exporters. You'd see a rotation if they do adapt a more normalized monetary policy, which many think will happen.
David Bonawyn here. Thanks for being with us. A quick question for you. So you focused on the import and export divergence there. What do you think it will take to see follow through on ROE or other type of return metrics around the perceived focus on corporate governance, and shareholder value?
So this has been improving, and it started with Abe in 2012, 2013, 2014. He had the 3 arrows. One of the arrows was improved corporate governance. And what this means is better shareholder representation, smaller boards. Japanese companies used to have massive amounts of cross-shareholdings, relationship holdings, and they'd hold each other's shares. So if something happened to one of them, you literally see a circling of the wagons and they'd get protected. So this was not necessarily conducive to building shareholder value. Now, there's pressure. There's some pressure. Pressure by the Tokyo Stock Exchange, as an example. Institutional shareholders putting on some pressure for these companies to increase their returns. What they have been doing better is a little better at capital allocation. They've been selling some of these cross shareholdings, and they've been using some of these proceeds to buy back shares because Japanese companies are categorically overcapitalized. They have too much cash on their balance sheet, and cash earns zero in Japan. So now we're starting to see more dividends, more stock buybacks. This part is getting better. But remember, return on equity is a fraction. The numerator is profits. The denominator is capital. They're getting a little better with capital. They need to work on that numerator. They need higher margins. They need to be running their businesses in a more efficient manner so they can catch up with the rest of the world. Yeah. It's happening, but it's slow. It's like watching a turtle.